Hi everyone, welcome back to the channel. In this video, I'm going to show you what I think is one of the easiest ways to make money in the stock market. This is a short-term strategy that has a history of providing good returns, and it's actually something that I've started to implement into my portfolio. Now, just because it's easy doesn't mean there's no risks involved. So in this video, we're going to be going over what this strategy is, some of the risks that are involved with it, and how I'm using the strategy right now in my own stock portfolio. And as always, this isn't financial advice and I'm not a financial advisor, so this is not a recommendation to buy or sell any stocks. All right, so let's get right into it. The strategy that I'm talking about is merger arbitrage trading. So merger arbitrage trading is very simple. All you're really doing is looking for a company that's being bought out, seeing the price they're being bought out at, and seeing if there's a difference between the price the stock is trading at now and the buyout price. So here's a good definition from this website. The basic aim or goal of merger arbitrage is to profit from the deal spread that arises following the announcement of a merger or acquisition. Now, merger arbitrage exists because most of the time there's a difference between the buyout price of a company and then the actual price that the stock is currently trading at. And when you can take advantage of that spread, that is the arbitrage, where it's been announced that this company is being bought out for a certain amount, and if you can buy under that amount, once the buyout is complete, you will get that full amount into your account. So for example, if we say company A has announced they're going to buy out company B for $80 a share, and the company B shares are currently trading at $40 each, what's usually going to happen is those trades are instantly going to jump on that announcement and get up to right under $80. So maybe they'll be trading at $78, $79. And so in that event, the best thing to take advantage of that would be to buy the shares at $78 or $79, knowing that there's a good chance they'll be worth $80 once this merger is completed. So there's two main types of ways that mergers can be financed. The first one is an all-cash deal. So that's like the example I just said, where a company buys out another company completely in cash for a certain cash amount per share. Another way a company can acquire another company is through stock offers. So what they can do is finance part of the deal through their own stock instead of using all cash. And this usually happens when a company doesn't want to use up all their cash buying a company. Instead, they can issue some more shares and use the proceeds from that to buy the new company. So in this video, we're just going to focus on all cash transactions because I think they're a lot easier to keep track of. And like I said at the beginning of this video, this definitely is not a risk-free strategy, and there are risks involved. If there were no risk, if it was announced that a company was being bought out for $80 a share, the stock would instantly jump up to $80. But we usually see a slight discount to that buyout price, and the reason is for some of the risks that arise from company buyouts. The first big risk is that the merger doesn't go through for some reason and the two companies have a falling out, in which case the company that's being acquired will most likely fall back down to its pre-buyout prices. So there are also other risks like antitrust regulations and then political and national security issues. This is actually an issue currently with Google, who offered to buy out Fitbit, but there's currently an investigation going into that and how Google would use the data from Fitbit. So even though the merger is announced, there always is a risk of it not ultimately going through. And that's why there's usually a discount between the buyout price and the actual price of the stock. Now, the other big risk is the time factor, which in the amount of time that it takes the deal to actually close. So if that company is being bought out for $80 and you put in $79 to buy the stock, there's a period of time you have to wait until the buyout is completed. And usually the company announces an estimated date of when this buyout will be completed by, but there are times where it runs late, and that money you have in that company is just going to be dead money until the buyout is completed. And even though this event wouldn't be a case of losing money, what it would do is lower your annualized returns, because the longer it takes a buyout to close and complete so you actually get the money in your account, the lower your annualized returns are going to be. So that's also something to keep in mind, where as much as the spread matters, what also matters is the amount of time that it actually takes the deal to go through. So I found a website that gives you a full list of all of the buyout deals going on in the public markets. It's mergerarbitragelimited.com. I'll put this website down in the description if you want to check it out, but they have a full list of all of the current buyouts that are happening in the stock market. And there's quite a few on the list right now. There's always a pretty good number going on at any given time. And even at the bottom, this website has a model portfolio of using only the strategy, the merger arbitrage strategy. And from the returns that they've been tracking, the returns have looked pretty promising. Where for each week you have annualized returns of up to 75%, and the lowest for the last few weeks is 47%. So the annualized returns for these merger arbitrage deals can be very attractive. All right, so like I said, I'm actively using this strategy in my portfolio right now. It's not a huge position, but since I am still holding a lot of cash, I figured it's better to make some sort of return instead of just having cash sitting in my account. So the company I chose to do this with is IMMU. Their ticker is IMMU, and it was recently announced that they're being bought out by Gilead Sciences. And there's a few reasons I chose to put my money into this buyout versus any of the other ones on the full list. The first reason, that it's an all-cash deal. So all-cash deals tend to be smoother. than if companies issuing equity or using equity to finance part of the deal. Another reason is that it was a friendly takeover. So this isn't a hostile takeover where the bigger company is basically forcing the smaller one into being sold. It was a mutually agreed upon deal, which does make it a very high chance of working out. So if we take a look at the official press release, this was announced on September 13th. So it says Gilead Sciences and Immunomedics announced that they're in an agreement where Gilead will acquire them for $88 per share, and that this is expected to close during the fourth quarter of 2020. So these are important pieces of information, and what we're going to do now is estimate the annualized return for this deal. So like I said, when it's announced that a company is being bought out, it's not going to trade right up at that price. There is going to be a discount to account for the risk of the merger not going through for some reason. So even though it was released that the stock IMMU was going to be bought out for $88 a share, right now they're only trading for $85.16. So assuming the deal goes through, all you would have to do is buy the stock now at $85.16, and whenever the deal closes, which is estimated to be in the fourth quarter of this year, you would get $88 credited to your account. So to figure out the annualized return, all you have to do is first find the spread between the buyout price and the price that the stock is currently trading at. So that would be $88 minus 85.16. So the spread is $2.84, and then you would divide that for the price you're paying for the company, which is 85.16. And that just about gives you a 3% return. And then we have to annualize that. So in the press release, it says that this buyout should be completed by the end of the fourth quarter 2020. So we're going to assume that it's at the end of the quarter, and right now is almost the end of the third quarter. So to make it easy, all you have to do is multiply this by 4, which gives you your annualized return, and that brings you to an annualized return of 13%. And that is pretty good. 13% is nothing to laugh at. So that's the reason just a few days ago I bought into the stock. Now again, there are risks. The first risk is that this merger takes longer to be completed, in which case this annualized return would go down. And then the second risk, and also the bigger one, is that for some reason the merger gets canceled, or there's some sort of regulatory investigation, and in this case it's likely that this stock would drop all the way back to the price where it was before the buyout was announced, which actually was a pretty far amount. The stock has doubled since then, so if this doesn't go through, the risk is seeing potentially a 50% loss or more for however much you put into this stock. So that's it for this video. Just wanted to show you the strategy that I've been implementing into my portfolio, and I figure I'll buy into some of these arbitrage opportunities every once in a while just to make some sort of return on my cash while I'm waiting for other stocks that I want to own to fall in price. So let me know what you think about this strategy. Is this something you've ever done before? Or if not, would you ever try this, or is it too risky for you? Let me know down in the comments. If you learned something new from this video, hit the like button as it helps out my channel a ton. If you're new to the channel, subscribe right now and hit the bell icon so you get notified whenever I upload a new video. So that's it for now, and I'll see you on the next video.